More of a psych question. I find myself able to hold losers until the end of time, but winners, I want to and often do exit immediately with a few ticks of profit. Obviously, terrible risk reward. Do you have any suggestions for tackling that mindset? Absolutely. Module 1 of the NADRO course is hours of me talking about exactly what you're asking. You, by the way, with your description of your trading, the good news is that you don't have problems. You don't need a psychologist. You don't need to go lay down on someone's couch and figure this thing out. You are normal. This is exactly the way what we call the natural human trader behaves. Our own biology, our own psychology has us this way. And I would say even especially people who have been successful in other areas of life outside trading, they come into trading and they have developed ways of mental models, belief systems, ways of thinking and doing things. And humans are naturally wired to behave exactly the way that you're behaving here. So what we have to do, as I alluded to earlier, is we have to rewire that. We have to give you new ways of thinking to shift that, because right now you're behaving like a caveman, right? You're behaving instinctually, which is gonna lead you the wrong way in terms of positive expectancy trading decisions. So what we have to do is to get you to think differently. We have to build different models for you to lean on and think about. You have to understand that there's a lot of randomness in markets. And you have to understand, I think the biggest thing for you here is what trading is. If you can take a deep dive into what trading is, and what trading is it's more like a casino, except we are the casino, right? How does a casino operate? A casino operates exclusively on designing a game with certain rules and certain risk management. They don't let you come in and bet $10 million on the next blackjack hand. There's table limits. That's their stop loss. They only are willing to lose 1R on one trade. Think about it. It's the same. And how do they make money? It's the expectancy. They design the rules. They design their system, just like we design a methodology in trade management and risk management and to have positive expectancy, right? In order to have positive expectancy, we need the rest of this formula to come out to give us a positive number. And the formula is our average winning trade size, right, in dollars, let's say, times how often we're correct, which is our win percent. And then I'm going to say plus. You could do plus or minus here. It just depends on how you use the plus or minus of negative numbers. So I'm going to say plus, and then we're going to use a negative number, right? It's it's a negative number, right? Your average loser is a negative number times your loss percentage, which is really just 1 minus your win percent, right? If win percent is 40%, 1 minus 40% is 0.6. Your loss percent is 60%. That's the formula. That's it. So therefore, what is trading about? It's about designing process, rules, steps that you take, tactics that you deploy in order to skew risk reward in your favor, and then have it to where it's good enough, it's right frequently enough to where your win percent is enough to where this formula ends up positive. I like to consider win percent very little, quite frankly. I like to consider whether I'm going to win or lose. Literally, if I had a coin here, I'd just flip it as an example and just heads or tails. That's how I see a trade. If you can truly start to see, well, let me finish that. It's heads or tails whether a trade's going to work. And quite frankly, for me, it's not even that good. A lot of times I'm 40%, like win percent. You guys see that from my trading today. A lot of paper cuts. And then when I get into a trade that works, that has a narrative behind it, like I did last night, like I'm back in it now in NQ, I'm gonna make some big R. I'm gonna get it. Okay. So it's the combo of that. So if I consider if you begin to consider, hey, I've got risk reward in my favor here, and I need to follow the rules like a casino has a pit boss and dealers trained and all these things to make sure that the participants follow the rules of their casino system, which is the same thing as our trading system. We need to be our own pit boss and make sure that we follow certain rules. So you need process for trade management. You need a process that says, okay, Doug, you're in a trade here. Because risk reward is in your favor. It's a setup for you. It's a playbook trade, and we can mentally view whether the outcome, whether it's a winner or a loser, as a coin flip, so we can start to become detached from that outcome. That outcome is meaningless, right? Half the time we're going to win, half the time we're going to lose. We don't know which one's going to win and which one's going to lose. We don't know. So let go of that outcome. So you see me telling you, we need to think about what trading really is helping you build a new model of thinking about what you're doing when you sit down and you put on a trade. Okay. So if you can think of that outcome as random, you can begin to detach from the emotional investment because you realize that it's stupid, to use a harsh word there. It's literally stupid to get caught up in whether or not the next trade, this trade, is one of the next several thousand trades over the next years that are going to be a small loss or a decent win or a scratch or whatever, right? Doesn't matter. Just like you think the casino, how stupid would it be if they were like, here comes the roulette spin. I hope it's not black because that guy's got a bet on black. Hope it's not red. They don't care. They created a system that has positive expectancy, and they just want to churn out sample size. They just want to get a bunch of trades on the books. They'll give you free drinks to help you stay there. You don't know what time of day it is in those places, right? Because they want sample size. We want sample size as traders too.